Good morning, everyone. Hope you're all having a wonderful Friday. Can you believe it is the end of the week, ladies and gentlemen? Welcome to the Friday edition with Coffee with Cramer and Colleen. I'm Don Cramer with the Cramer Group at Urban Nest Realty. Cheers to you out there today. Thanks for tuning in. Colleen sends her best. I'm actually checking in with her a little later. We've got a listing coming live, so she's getting that listing prepared for our great photography and video team. So we're going to take some great images for the property to showcase it, so buyers have a great understanding of what the house is prior to stepping in. But today we are excited because we're kind of following on last week's episode where we kind of gave you the home buyer 101, and we really kind of talked about it from the real estate agent side. Now today we're excited because we have a great colleague and friend of the show, Michelle Leaf, joining us today. And Michelle is going to talk to us about us from the lending side. So Michelle, welcome to the show.
Thanks, Don. Thanks for having me. I'm glad to be back, and I am so looking forward to it. And this is a great opportunity to help educate new buyers, even old buyers, or experienced buyers on the loan process.
Absolutely. Thank you. And so do you have a breakfast beverage today? I'm still kind of working through my coffee from our meeting earlier today.
I finished. I've had about all the coffee I can do from our early morning meeting. So
Fantastic. And so, Michelle, thanks for joining in. I think when we kind of touched based on it, it's so interesting where we're dealing with clients all the time, and this is a great thing from your side, from a lender side who's working with, has a great client base to work with, my side from the client base for the real estate side. However, these questions come up because this is something you don't do all the time as a home buyer.
absolutely, and even if you did, the guidelines or the policies and the procedures change just as quickly. So and different economic environments require different things, and as we have all just experienced with COVID-19.
Absolutely. So, for something that basically people do on average every 7 to 10 years, we're kind of taking this video as a bit of a home buying 101, or a little refresher course. So if people are thinking about buying a property here in 2020 and during COVID, or maybe even into 2021, we've got some great Q&A, some great information to go through that can help go over this. And Michelle's was great to kind of provide some ideas and a little bit of guidance here in our little 101 series for people. So Michelle, let's kick it off and say, okay, well, you know what? We're thinking about buying a home. When should we see a lender? When should we go see you?
The minute you start thinking about it, because like I said, because lending environments change,
Yep.
You want to be prepared, and you want to get pre-approved. You want to know or if you need to do some credit repair, save some money, find out what kind of loan programs that would best fit you, and kind of put together a buying plan. And that way you will be prepared to know what to do next. And because the worst thing is you go out, you find the home of your dreams, and you have things that you need to take care of, and you can't qualify for that home of your dreams, and then you're crushed. So the best thing is, meet with a lender as soon as you start thinking about it, even if it's just to ask them a question. Maybe you're not even quite wanting to sit with them or put in your application, but it's okay to call them and, ask questions.
Yeah, I think in a lot of cases, I hate to say this, but I think it's like when people walk onto the site of a car dealership. They may not be ready, but they're afraid they may walk home with a car. But now more than ever, it is, we're about questions and answers and being a resource. If it just happens to fit, great, we'll move forward. But at this point in time, Michelle, you would, be able to give them a good idea. It may work towards their advantage right now because of interest rates and buying power, and they may be able to afford more than they were expecting originally.
Absolutely. And that's a good thing to know, and maybe it's a great motivating factor, if they do need to do a few things, then we can do that because, with the rates being as low as they are, it is affording you to buy more of a house. So that's where it really comes strategic. I mean, people have to realize buying a home is part of building your own personal wealth, and having mortgages also complete your financial picture. So it's great to sit down and see how that fits and how it'll mesh with their financial goals, personal goals, and just housing goals.
Yeah, no, absolutely. Absolutely. So, okay. So on the 101, they've said, whether it was coming from myself or you knew the client or they're researching, very early meet with yourself from the lending side. And then we go, there's what's called pre-qualification. Could you give us a little 411 about what pre-qualification is about?
The pre-qualification is like a Q&A.
Okay.
And, a loan officer can take all that information over the phone and just kind of talk and just go, verify over the phone. Have you been on your job? Have you done this, and take some brief information regarding income and assets. Sometimes it requires a credit report. I usually try to get the credit report if possible, but it doesn't require any type of verification of documentation. So you can get, at least a ballpark figure of your budget.
Right.
So that's kind of what a pre-qualification is. And it first and foremost, it doesn't commit you to that lender or anything. It's just part of what we do as a service.
Right. So, I mean, this is a great overview where you can discuss how much income that that a client or prospective buyer may make, what maybe some of their major expenses are, and maybe like you said, what where their credit sits to give you an idea of what their purchasing power essentially is.
Absolutely.
Yeah. So there's also a lot of people get that next little piece there too, which is there's pre-qualification. Well, actually, maybe I'll take a quick step back. So let's say they find a place. We find a they're pre-qualified. We've met. All three of us, the client, you from the loan side, me from the real estate agent side, realtor side. We know how much buying power they have. We've went out, we've looked at some properties, we've selected one, and at that point in time, we would start writing up an offer on the property. And at that time, is it okay that they start working with you on the approval process, the application?
I would prefer that they had already started with,
Okay.
if once they go through the pre-qualification, most times, a lot of lenders like the pre-approval process, which is different from the pre-qualification process.
Could you explain
Pre
that?
Yes, the pre-qualification is having a brief conversation without any documentation. The pre-approval process is more, I think, helps you really truly understand the process. It requires a complete application. It requires the credit report and supporting documentation, whether it's pay stubs, W-2s, bank statements. So now you really have a good loan program package. And so when I issue a pre-approval, I have verified all of that stuff. So when you go out and show a client and they fall in love with the property, you put in an offer, there is a pre-approval, which most listing agents prefer a pre-approval as opposed to a pre-qualification. And you really have a comfort level, and the buyers have a comfort level that, okay, I know I can qualify if I just, follow the lender and see what my budget is and not go over.
Yeah, absolutely, no question. And from our standpoint, if we can get to pre-approval, in advance of home inspections and appraisals, it gives us more purchasing strength from getting an offer accepted, because we are dealing with this busy market, multiple offers. So having basically saying, okay, your client, you've already worked with this buyer down the process. We've already, paperwork has been submitted, credit reports have been drawn, data is coming together. We know that this is more than just, okay, we just kind of filled out a little initial questionnaire. We know that this person has got a high likelihood of qualifying for this loan.
Absolutely. Absolutely. And I think a lot of listing agents want that. They want to know you've pulled credit, the credit scores are good, the income's been verified. I mean, they don't want to have a pre-qualification and then when I get supporting documentation, it doesn't match. So when you have a pre-approval, all that stuff should add up.
Excellent.
And, so it's good.
So, kind of also, so we've kind of talked about sort of the steps to kind of go through the paperwork, things of that nature. But there are these different types of loans. And I get these questions a lot where I'll get somebody, we're looking at a type of house and they go, well, what about this loan program? Or what about that loan program? But they're kind of like a couple of major ones that most people fall into, right?
Right, and that's kind of what we in the mortgage industry call agency loans. I mean, typically most buyers fall into, one of these three loans. You have your FHA loan, which many first-time home buyers are gravitate to because it requires the least amount down at 3.5%.
Mm-hmm.
The caveat to that, though, is even if you have a buyer who makes, a good income, the maximum loan amount for this loan is $345,000. So it also depends on what kind of market and the price points of the median sales prices of the community that they want to buy in.
Right.
So, and the second one is a conventional loan. Now, the price point for that can go up a little bit higher. It's the conforming loan amount here in Clark County is $510,400. Now, that being said, with a conventional loan, there are a couple loan programs that can require that you can get in with 3%, but that also has income restrictions. And with that being said, you won't get to $510,400 with only 3% down.
So that's kind of the push-pull there, isn't it? I mean,
exactly.
There are programs you can get into with less down, but you are limited because they're thinking, okay, well, we're limited. You're limited as to how much you can really take on from a lending amount.
Exactly. Because of the DTI, at 3% down on a $500,000 home, you're going to need a good income. But if you're limited to, I believe it's about 70,000, give or take, then you can't qualify for, earning that much for that much of a house. So there is a give and take on each loan program.
And so on the conventional, then there's obviously for veterans that have served the active duty, retired and such. There's the VA programs.
Right. And VA loan programs are a great way for our active military as well as our veterans to get into because it's, most start with a 0% down. And VA has, depending on the credit score, they will use the credit score as a guide, and they also use what we call residual income. So after they've met all their monthly obligations, there is a requirement that they, depending on the size of the family, they would have to meet that requirement. So that's kind of, so it does give a little bit of flexibility. If there's a lot of reserve left over in monthly obligations, then you can push those ratios a little bit, and the maximum loan amount for zero down is $510,400, but you can go up and over that amount. You would just need to come in with a little bit of a down payment.
Okay, so if you have something, let's say it was a $600,000 property, you would have to come up with down to sort of push it into that max limit range.
Right. What would happen is that between 510 and 400, you subtract that from the 600,000, and then whatever the difference is, 25% of the difference is what your down payment's going to be.
Oh, okay.
So, Yeah, so it's not 25 of the whole purchase price. It's only going to be 25% of what's over the conforming loan amount.
Oh wow. Okay. Well, that's for those out there. I mean, that really gets you some purchasing power.
It does, and VA doesn't have a maximum loan amount because you can do that.
Okay. Wow. And considering a lot of retirees, they may be first career, or still active duty, high enough, maybe higher high enough with whether it's time served or rank, or they may be retirees and they may be on a second income position. So that could that with that capability, that would allow them, they could get into something pretty it gives
Pretty
them a wide
nice.
range.
Absolutely.
Okay. And then what about the great, my favorite one, the jumbo? It kind of sounds like we're going to kind of biggie size this loan, as they say at
Right. Well,
Wendy's.
yeah, well, a jumbo loan is anything over the conforming loan amount of 510,400. So if you had 510 and 401, now you're into the jumbo category. What I typically do is to calculate, how can we get it back into the conforming loan amount, especially if they're close, because it impacts the rate. It also requires a little bit more down. 10% is on the average. There are some programs that will allow you to have 5% down, but you would have to really, your credit score it has to be almost perfect. So it just kind of depends, and not all lenders have it. I'm not even sure if we have it right now because the jumbo market has been impacted by COVID-19. So that's kind of like an ongoing basis that we're constantly adjusting to what's happening in our market right now, and there's extenuating circumstances with that. So jumbos require, like I said, a little bit more down, higher credit scores, obviously higher income, so so the underwriting's a bit stricter as well. So, most people who go into the jumbo category have, they're not on their first home.
Right. I mean, this is yeah, like you said, not on their first home. This is they're this is probably home two or three, maximum earning power in their career.
Right.
Um, you're looking at more, you're starting to move into the mid luxury segment.
Right.
So, and those are jumbo. And like you said too, right now because of COVID, there's a bit of the lending on jumbos have have reduced than, let's say, pre-COVID. I think at pre-COVID, jumbos were looking, availability on jumbo loans were pretty good. However, there was a period of time even some of the major banks were ceasing jumbo lending until probably even recently.
Yeah, I mean, we see them trickling back in, but we also see the guidelines changing right along with it. So some lenders are afraid to offer them because at any given point in time, that jumbo investor can just say, "Oops, sorry, we changed our mind,"
Right.
and that's happened too.
Yeah.
So
Exactly.
so it's one of those things, that we have to be aware of when you're going into that category of loans.
So we've got the FHA, we've got the conventional, we've got the VA, and we've got the jumbo, which are kind of like the big four, just about.
Right.
And then there's definitely some, we've seen some states or situations with down payment assistance programs, but again, they have their pros and cons as well.
Right. And in Nevada, we have our down payment assistance programs. Those are, anywhere from 2 to 4%. On occasion, there might be some 5%, but we don't really advertise that yet because that can come and go really quick. So it's on average 2 to 4%. Again, there's income restrictions of $98,500 per year, and the rate is slightly above the market rate.
Okay.
And then there are program fees that go along with it. So, and their debt to income guidelines are hard stops, and credit scores hard stops. There's no fluctuating in those types of programs, but I still think they're a really great way for a first-time home buyer who has a good job, good credit score, just doesn't have all the finances and saving money to put down on a house. So this really helps them get into a house and build some equity.
Right. Absolutely. And on that as well, so we know their loans, and I think one thing, you kind of go, okay, I go get a loan, but there's obviously costs to securing that loan. It's, one, two, not just from a bank, but also from you're all a brokerage.
We're a direct lender.
You're a direct lender. Okay. Direct lender. Sorry about that. And so there are definitely fees and costs associated with a loan. What types of fees or costs should a buyer be aware of stepping into this purchase process?
First and foremost, I always tell when I'm consulting with a borrower is, are they prepared for the upfront costs? Those are things like even your earnest money deposit, because they sometimes, even with down payment assistance, they think they're going to pay for everything and they're not going to have to come up with that upfront cost. You will need that. The in-home inspections, appraisals, those are upfront. Now, they all get credited to you at close of escrow.
Yep.
Now, once you get past that part, you've got escrow fees, you've got lender fees, taxes, homeowners insurance. We require, a full year upfront. A lot of prepaid expenses where we're going to prorate your property taxes. So all of that gets put in and into your loan estimate, so you have an idea of how much this is going to cost you. So there are fees that they need to save, and have available to them. And I usually ask them, do you have assets available to you for these fees?
Right. So to kind of break that down to a couple of chunks, there are probably fees associated for the actual securing of the loan, how much that loan costs the buyer. Then there are requirements to purchase for the loan, such as the appraisal, such as, if you're getting a loan you're going to secure a lender title policy.
Right.
And then there will be, and also home insurance, because you'll need to show proof of homeowner's insurance, whether if you already prepaid for it or it's out of escrow. And then lastly, probably additional prepaids, such as, like you said, taxes, maybe a homeowner association fees, things of that nature. They're kind of part of the broad general closing costs in order for this loan to be secured and in place.
Absolutely.
So with that in mind, in part of that consultation, how will they get an idea up front about sort of how much, because I know I speak to buyers a little bit about that, but how much do we talk to them a little bit about up front about those things, because we know they are going to need to prepare to have some cash readily available over the process of writing an offer and going into closing.
Right. What I do is, I said a little previously, that's why I like to do pre-approvals as opposed to pre-qualifications.
Yes.
Because once I get all that information, I put it into, my computer, and I can generate a loan estimate that gives them, a transaction summary. So a lot of times I'll attach that transaction summary to the pre-approval letter on the same email, and then I will go over it with them, so they have an idea. Okay, this is all the costs that I'm looking at. Now, I also tell them the bottom line is all your costs. It doesn't mean it comes out of pocket. It means part of it's either being financed, like your upfront mortgage insurance on an FHA loan. So, if that's $5,000, it's not $5,000 coming out of pocket. It's tacked onto your loan.
Right.
If there's, a seller's concession, or your earnest money, a lot of that's not taken into account. This is the broad number. And then as you progress during the process, all of the credits start coming off, and then that number gets, smaller and smaller. And I usually coach them, okay, this one's going to be smaller, and until you actually sign your documents and finalize it, that's when you actually get the final cost of your loan, because that's where, because all the fees are always adjusting, all the prorations are always adjusting.
Right.
So,
exactly.
yeah.
So yeah, we're sort of like kind of closing that gap over that period.
Right.
And so while let's say during the process we've written an offer, you've already done pre-approval, or I'm sorry, not pre-approval, pre-qualification. We went and shopped for a property. We found one the buyers like, wrote an offer. They've already begun the loan application process. They've started sending documentation to you. You and I are in contact. We're going through the different pieces of the home inspection, the appraisal, which in a lot of cases right now too, we're negotiating some of those timetables. Right now, a typical, that's another great question for people. How long should we expect for on average for an appraisal and a loan contingency, what we call the loan contingency, to be completed?
Right. And, I'm starting to find out that appraisals are taking a bit longer.
Yeah.
In this environment, because we're in a refinance environment. And so appraisers are getting really, really busy. So, so it's like, okay, that appraisal contingency usually was about, 3 weeks, 21 days. Sometimes I've been asking for a little bit more, only because you just don't know if that appraiser is going to be able to do it in that time, because they're just inundated with refinance transactions. Yeah. And I'd rather, what is it? Under promise and over deliver kind of thing. And so, but everything is, well, if we get it sooner, that's great. Right. But at least we're setting the expectation that it is going to take longer. Now, purchase transactions can still be, completed, within 30 days. But again, that's provided everything works. So, just to save the seller and the buyer some stress and give them a better, maybe 45 days would be good. But if we can close in 30, we will definitely do that, because what we don't want is asking for extensions, because right. Then everybody thinks something's wrong. No, it's just all lenders and appraisers and escrow companies and everyone is maxed on their appointments. We are in a very busy time.
Right. Exactly. So, there's just a lot of frequency going on, and because of COVID too, things aren't being processed as quickly either. There's just, we're
right.
We're not in office.
So there's a lot of that, and with all of that, every step of the process is busy, from processors to underwriters so it's every person, in this industry is feeling that funnel of getting squeezed a bit.
Yes.
Absolutely. To get it done. And we are trying to do everybody's jumping in, doing other parts of jobs that typically they don't normally do. Yep. We're doing them.
Absolutely. No question about it. No question. And so when we get down to the last little bit, let's say, okay, the appraisal comes in at least the agreed purchase price value, and it looks like the loan's going to happen. There's now sort of like the final steps of the loan process. before close of escrow. Could you sort of highlight those?
Okay, so once the appraisal comes in, and hopefully by then the initial credit underwriting has already taken place, so we have to resubmit the conditions, the appraisals for that final stamp of approval and get what we call a clear to close. At that point, let me back up just for a sec. I've already locked the loan, and so you've got a new loan estimate going on, closing disclosures going out, and we're prepping the file to go to the closer. And so there's a lot of things that are happening, and each part of that is being done by someone else. So there's a lot of coordination going on. So a lot of emails flying back and forth, making sure everybody's on the same page, along with the buyers. What I do is it's like telling my borrowers, please contact me. Your disclosures are going to be confusing. So I go line by line and explain them so my team can at least keep that file moving forward to get to the closing department, and then getting the documents over to escrow and all of that. But everything is happening all at the same time, usually.
And there are some things because of the Great Recession that have been placed into law with regards to the closing disclosure and a window before that those things can be reviewed, approved, and such before documents can be sent to the escrow title company for closing.
Right. So what happens is, say I lock a loan, a new loan estimate needs to go out, because that's what we call a change in circumstances. As soon as the borrower signs that, then I can have requests for the closing disclosure to go out. Now, once they sign that, the soonest they can sign is 3 business days later. So they can't, do 1, 2, 3. So there are timing where we're always looking at, okay, count the number of days. Some things we'll count a Saturday. Other transactions will not count a Saturday as a business day. So we're all counting those days, and once the buyers sign, then we can fund and record.
Yeah, absolutely.
But let me back up on that. Once they sign, the file goes through another audit. So it's constantly being audited until we actually fund and record.
Right, exactly. And so closing disclosures, reviewed with the buyer, they're approved, documents get sent out to in Nevada, where title state gets sent to title and escrow. The buyers then go to title and escrow for signing, which will be in a separate. We're going to do escrow and title in a separate video, but they need to be, because there's a loan, it needs to be in person, at least with a notary. I mean, because they can be remote. But those require what is termed as a wet signature.
Yes, there's certain documents that require an actual wet signature, which is a hand signature, and that's the note, the deed, I think the 4506T, the tax request for tax what do you call that word? I forgot that word. Anyway, transcripts. There you go. Transcripts. And so there are a couple of, and I believe the settlement statement needs a hand signature. So there's a couple things. A lot of the other disclosures can be, electronically signed.
Right. And so, those disclosures, they're signing, and we always advocate signing 1 to 2 days in advance of the actual closing, because the closing day is really just a formality.
I'm not sure. I usually sign and have my client, the borrower, sign, and then we fund and record the next day.
Well, with the buyer. I mean, we try not to sign the day of funding.
No, not if at all possible. Yeah. I mean, we can do it, but it's a lot stressful for everyone, because the borrower needs to sign first thing in the morning. The paperwork has to be sent back to the closing, or the funder has to go through the audit again before, the wire usually has already been ordered but it hasn't been authorized. And then before that happens, we have to make sure that the buyer has wired their funds ahead of time into escrow as well.
Exactly, and that's what I was referring to. Not because
Okay.
a lot of times, a lot of people think the closing day is actually the day they go sign
Not
in
well,
advance.
it depends.
Yeah,
So that's why I have a conversation depending on who I'm speaking with. And, some, I think closing day is the day you fund and record,
right,
but other
exactly.
people think it's the day you sign. So I try to let's all get on the same page and clarify that. And I have that conversation with every single person
Yeah,
so that we all are on the same page.
absolutely, no question about it. Because that is definitely important that they understand that there are differences between those. And so, Michelle, there's a couple of things that we may toss around because we're an industry that people may not exactly be aware of, or maybe get caught off guard, or maybe they'll. Sometimes what I'll do is I'll just kind of go, okay, and then I'll go look it up on Google later. So, what
Mm-hmm.
are things, so we get things like FICO score. I mean, what if if a buyer hears that coming from somebody, what is being referred to there?
The FICO score is kind of used interchangeably with a credit score, but the FICO score is actually an algorithm that they use, and it stands for Fair Isaac Company. I guess there's a guy whose last name was Fair, and the other guy was Isaac, and they came up with this algorithm that the credit bureaus use to determine and calculate the credit score.
Yep.
So it used to be just one thing. In fact, I remember all we ever did was either say Fair Isaacs or FICO. Now we say credit scores because now it's being used across all three bureaus
Right.
on how
Gotcha.
to determine that. So we use it interchangeably to make it simple.
Right. Absolutely. Absolutely. And then two, we hear these words a lot, Fannie and Freddie, and they seem to come up a lot when talking about mortgages and lending. Well, who are Fannie and Freddie?
Fannie Mae and Freddie Mac are actually government entities. It's weird because they're GSIs. They are a part of the government, but not run by the government. So they're kind of separate, and they also determine the lending guidelines. They are also the people who actually buy the loans after they've been originated, and then secure them in mortgage-backed securities and put them on the stock exchange. So they do all the guidelines, and those are the guidelines that we fund and prepare loan packages as well. You also have Fannie Mae rates, interest rates, and Freddie Mac. They set their own interest rates as well. So they have their interest rates. Lenders add on whatever they need to get the final interest rates that is presented to the consumer. And most of that is relatively competitive between lender and lender. And that's kind of what we refer to is who's going to buy the loan in the end.
Oh, exactly. Great. That's awesome. And you actually brought up the next term, interest rate. So we see interest rate, we see APR, and sometimes that confuses people. What's the best? How do you best compare those for people?
Okay, the interest rate is what is on your note. That is going to determine what your principal and interest payment is going to be. Now, the APR is the annual percentage rate. It is the cost of your loan reflected in a percentage for the first year. So if you were shopping rates, people are so fixated on shopping rates, but that's not the only thing they should be looking at.
Exactly.
Because you may have a really good rate, but if that APR is a percentage point higher than that rate, that is also a very expensive loan. So you kind of want to stay between whatever the interest rate is and about 0.5%. If it's, I've seen it where the interest rate, you've got the borrower saying, well, look, can you beat this? I've got this really incredible interest rate, but the APR was 2 percentage points higher. I'm like, how much are you paying in closing costs for this?
Right.
So that's what you really have to look at, because sometimes you might not want to pay that much in closing costs, especially if you are tight on cash to close.
Absolutely. That's a great point. I mean, so and that is a big thing because not always about the rate. There are these other little components.
Absolutely. There are a lot of factors that go into it. So if you're rate shopping, I think back in the day, 20 years ago, that's pretty much what it was. My interest rate, do you have the rate sheet?
Right.
And it literally was on one page, one rate sheet. That is not how it works anymore. The rates can be anywhere from 2.5 to 6, depending on what meets the buyer's criteria and what we're trying to accomplish during that process.
Right. Absolutely. No question about it. No question. And then two, we hear these three initials quite a bit, called PMI. Where'd PMI come from? What's that about?
PMI is private mortgage insurance, and that is insurance required on a conventional loan. And conventional loans are governed by Fannie and Freddie, that when you don't put 20% down, so anything less than 20% down requires private mortgage insurance. And what that does is it insures the loan, not the buyer or borrower. It insures the loan in the event of default. Okay. So that it's kind of like an insurance policy on the loan itself. So if the loan goes into default, PMI kicks in, pays covers not the whole loan, just part of the loan for the lender. Okay. So if it covers 25% of the balance, then if the lender has to go into foreclosure, sell the property, hopefully the two will equal to the loan balance.
So that PMI, like you said, in case there is a default because they couldn't put enough down, or right, there's not enough equity position in the home, this PMI sort of is kind of a gap.
Right.
Coverage.
Right.
Okay. And it is and all conforming loans less than 10%, less than 20% down have a PMI
requires
component.
PMI. Yes. Mm-hmm.
Okay. And let's see. I think that kind of covers some of the big questions, the big items there. Michelle, is there anything that you're running into, or you see as common with people that are first-time home buyers, or they haven't done this in 7 to 10 years that we haven't covered?
What I'm seeing with first-time home buyers is, like at the very top of the show, about meeting with your lender, yep, getting a financial education about the whole process, because there's no place, not in high school, not in college or anywhere, that teaches you about this. And I like to educate my first-time home buyers, or even subsequent home buyers, because like you said, subsequent home buyers bought their house 10 years ago. The rules were different 10 years ago. So now I have to get them up to speed on the new rules of right, how we put together loan packages and how we qualify people. At the end of the day, what we want are successful homeowners. We don't want to do loans that people will go into default. We don't want to do those things because it doesn't help anyone across the board. It doesn't help the economy. It doesn't help the lenders. It doesn't help the borrowers. It helps no one. So a lot of these stopgaps are actually to help people be successful homeowners.
Right. No, absolutely. Absolutely. And that was probably the biggest market change from the 08 to 2010 financial crash, which we call the Great Recession, because it was some lending practices and overbuilding of homes that sort of caused that problem.
Right.
And then
right.
If you look at us in a COVID world, between federal government stimulus, forbearance programs, and like you said too, a practice over the last several years of making sure people are able to afford their homes, afford their things, have sort of caused the home, at least for now, certainly a robust real estate market.
Exactly. So a lot of these, you never know what's going to happen. No one anticipated COVID. And, so the government jumped in with the forbearance programs. and and now they're coming back out of it. So it depends on the loan servicer. So there's a lot of things that go on, and as originators, we're also trying, okay, well, wait a minute, they've been on unemployment for the last 60 days. How do I calculate their income at this point?
Right.
So we almost have to adjust guidelines as we go along, as the environment changes, the economy changes, and so there's a lot of things that I may say something this week and next week it's obsolete. So, and that's, so bottom line, if you're going into buying a home or whatever, just know it's not that we don't know what's going on. It's just things are changing so quickly. So be flexible.
Yep.
With your lender, be flexible. Just kind of go with it. It's like, okay, that must have changed. And I'm probably going to say, yeah, it has. So this is what's going on. That kind of thing.
Okay, absolutely. Absolutely. I mean, it is, we are in an ever changing world, including us in real estate, including yourself in lending. And so, like you said, both flexibility and, as you know, as well, us as a team, constant communication with our clients,
Right.
Making sure that they have the up-to-date information, because, like you said, rules, regulations, things may change that may have impacts that weren't even brought up, or weren't even being thought of even a month or two ago.
Absolutely.
Yeah.
Everything's changing quickly. So
Absolutely.
we just learn quickly and adjust.
Adapt and overcome.
Exactly.
So, well, Michelle, this has been great. I think this is a great sort of primer for people that give them an idea about sort of the lending process and getting towards obtaining the loan that they need. Also, too, sort of what kind of loans are out there. Oh, here is one last one. Do's and don'ts. Do you have a top couple of do's and don'ts while somebody's buying a home and getting a loan?
Yes, I do. Do not finance anything new.
Okay.
Because meaning don't go out and buy a car or the furniture because you're going to buy this new house, because we will do a soft pull right before we fund that loan.
Okay.
And people will know. Don't change jobs without letting your lender know, to determine if there's enough time for you to do so and what we need to do before you do it. We will call right before we fund the loan to see if you're still working there. And a lot of borrowers don't know that we're, like I said, until it's funded and recording, that file is still being audited.
Right.
So those are, before you pay off anything on your credit report, talk to your lender, because you're thinking, well, I could get a higher credit score. But once that credit report is pulled and you meet the qualifications, unless your lender says pay something off, don't do it, because we're going to do a soft pull and that may affect your credit score. Say you needed a 640 and it goes down to 635 because we did it at the very end. Right. You now no longer qualify for that loan. So stay in constant communication with your lender to make sure whatever you're doing is going to be okay.
That's a great piece of advice. So if don't think in a vacuum about, okay, I need to go get the furniture now. Let's open up a credit line at XYZ furniture store, or you know what, we're having a problem with our car. Well, let's defer that until after closing, or even if a lease is up, I would take as well.
Right.
Yeah.
Right.
And then, like you said too, on the flip side, you may be thinking, oh, this is a good thing to go do. You know what? I've got an extra $5,000. I'm going to pay off XYZ credit card. But like you said too, that may impact that credit report pull.
The credit score, exactly, and it may lower that credit score. And so once we qualify, we don't want you to touch it.
Got it.
Until, or what I would have people do, if it's a requirement of the loan to pay something off, pay it through escrow.
Got it.
Because then the credit score stays the same.
Fantastic. Well, Michelle, this has been very informative. I greatly appreciate you being on today's show. And if people have some questions, how do they reach you?
They can reach me at my email address at michelle.leaf@dkmortgage.com, or they can call or text me at 702-767-8174.
Okay.
I would, and you can even reach me on my Facebook page at Michelle Loves Loans. So you can send me a message there, and I'd be glad to answer any more questions they have.
Well, thanks, Michelle. We greatly appreciate you being on today's show. Wrapping up, I hope you have a wonderful weekend.
You too. Thanks, Don, for having me. And same here. Have a great weekend, and
Thank
we'll
you.
chat soon.
Yeah, absolutely. And thanks everyone for tuning in to the Friday edition of Coffee with Cramer and Colleen. I'm Don Cramer with the Cramer Group at Urban Nest Realty, and we've got some more Coffee with Cramer scheduled starting again next week. So if you get a chance, tune in. If you have any questions for Michelle or about getting a loan or looking to purchase a property, reach out to Michelle as she mentioned too. Also reach out to us. We'd love to help answer those questions that you've got on buying a house here in Las Vegas. So until next time, wishing you a wonderful day. Take care. Bye-bye.
Bye.